Welcome to today's explainer. So today we're looking at the movement of capital. If you imagine a business as a living, breathing ecosystem, well, capital is the flowing water, the liquidity that keeps the whole thing growing. But here's the tricky part. Just because a company reports a profit, it doesn't actually mean the liquidity is where it needs to be. So let's trace how we analyze those hidden invisible currents.
Okay, let's dive into this. It's entirely possible for a business to show a massive paper profit, yet completely lack the bank balance to actually make payroll. Margin is, well, it's really just a concept, right? But tangible cash? That is reality. To truly assess the financial health of a company, we have to track this lifeblood far beyond the basic profit and loss sheet. We constantly have to ask ourselves, where exactly is the money going right now?
To start answering that, we really need to begin with a macro view, and that's the funds flow statement. You can think of this as the weather radar for our entire business ecosystem. Basically, a funds flow statement tracks the changes in working capital between two specific balance sheet dates. So instead of getting bogged down in every single tiny transaction, it looks at the broader shifts. By tracking these changes, this statement acts as a literal early warning system. It guides how funds are used, it helps management with high-level planning, and most importantly, it raises a massive red flag if financial storms are gathering on the horizon.
And this brilliantly illustrates the basic mechanics, sources of funds versus applications of funds. On the inflow side, capital flows in. A company might, say, issue shares, take on loans, maybe sell off an asset, or simply generate operating profits. But on the outflow side, the capital drains through applications. The company is, repaying those loans, purchasing new assets, absorbing losses, or paying out dividends. It's pretty straightforward. If your applications are consistently outpacing your sources, your working capital pool is draining way faster than it's filling up.
Now, as incredibly useful as the funds flow statement is for that big picture strategic view, it actually has a pretty strict limitation. See, working capital includes things like inventory and accounts receivable. That's money that is tied up. It is not immediately spendable. We need something a lot stricter, and that shift in focus comes directly mandated by Accounting Standard 3, or AS3 for short. This standard basically forces a business to zoom all the way in from the broad idea of working capital down to the unforgiving reality of actual hard cash pools.
Let's move to and see how this builds out. AS3 mandates the cash flow statement, which completely strips away the illusions of working capital to focus strictly on actual cash. To make sense of the daily financial chaos, this standard forces businesses to sort their cash into three very distinct buckets: operating activities, investing activities, and financing activities. By compartmentalizing everything this way, we can clearly identify exactly what part of the business is generating lifeblood and what part is just consuming it.
The first, and honestly probably the most critical category, is operating flows. This is the day-to-day operational core of the whole business. Operating flows include the actual cash collected from your customers minus the hard cash payments made for daily expenses, inventory, and taxes. If your business is healthy, this flow should be a strong, positive, self-sustaining river. But if it's negative, well, that means the fundamental day-to-day business is bleeding cash just to keep the lights on. Next up are investing flows. This covers asset and investment transactions. Basically, it's the capital spent acquiring or selling long-term infrastructure. So when a company buys a brand new manufacturing plant or upgrades its servers, that is cash flowing out. But if they sell an old warehouse, that's cash flowing in. And a quick side note here, a negative cash flow in this category isn't inherently a bad thing. Actually, scratch that. It often signals a company that is confidently building out its future capacity. Finally, we have financing flows. This involves all the transactions with the owners and creditors. We're talking cash from issuing shares or securing loans, which is then offset by loan repayments, interest, and paying out dividends. You can think of this as the external funding mechanism, like borrowing the water to fill up the pool, which is absolutely necessary to support major investments when your daily operating cash just falls a bit short.
Now, what's really interesting when we juxtapose these two tools is how clear the contrast is. The funds flow statement, that's our broad strategic map. It tracks theoretical shifts in working capital to give us a solid forecast of financial health. But the cash flow statement, operating under AS3, offers a much sharper, much less forgiving view of true liquidity. It focuses strictly on actual cash movements. So the funds flow gives you the map, but the cash flow tells you if you actually have enough gas in the tank or cash in the bank to survive the journey.
Ultimately, financial analysis isn't just about looking at one number in total isolation. It's really about understanding the gap between the promise of capital and the cold reality of cash. I mean, you can have a massive warehouse completely full of valuable inventory, making your working capital look absolutely fantastic, but you definitely can't pay your employees with unsold boxes. So the crucial point is, if your working capital looks perfectly healthy, but your actual cash flow is completely drying up, how long can your business truly survive? Thanks so much for tuning into today's Explainer.